What do farmland in Nebraska, a warehouse outside Memphis, and a data center in rural Virginia have in common? They're all owned by the same handful of people, and once you understand why, you'll never look at the economy the same way. Why billionaires are buying America? Here's a question worth sitting with for a second. Why are some of the richest people on the planet putting billions into physical assets, dirt, buildings, power infrastructure, at the exact moment everyone else is chasing stocks, crypto, and whatever's trending this quarter? It's not nostalgia, it's not diversification for its own sake, and it's definitely not what the headlines make it sound like. Because here's the thing, this video is not going to claim nobody bought America, no single person owns the country, controls its food supply, or pulls strings from a boardroom. That version of the story is easy to believe and almost entirely wrong. What's actually happening is more interesting, and honestly, more useful to understand. A specific group of investors, some of the wealthiest people alive, have spent the last 20 years quietly acquiring the infrastructure that everything else depends on, not the country, the systems underneath it. Break it down by category, and the pattern becomes obvious. Land, housing, warehouses, energy, data centers, agriculture. On the surface, 6 unrelated sectors. Underneath, one shared quality. Every one of them is something the modern economy literally cannot function without. That's the thesis of this entire documentary. Billionaires aren't buying America, they're buying the parts of America that nothing else can replace. And once you see that pattern, you start noticing it everywhere, starting with the most surprising acquisition of all, dirt. If you had to guess who owns more private farmland than almost anyone else in the country, a software founder from Seattle probably wouldn't be your first answer. But according to widely reported land records, Bill Gates has spent the past 2 decades assembling one of the largest private farmland portfolios in the United States, reportedly north of 250,000 acres, spread across more than a dozen states. And he's far from the only billionaire doing it. Investment funds, pension managers, and wealthy individuals have been steadily increasing their farmland holdings for years, according to data tracked by the USDA. So why farmland? It's not glamorous. It doesn't generate headlines the way a tech acquisition does, but it solves 3 problems that almost no other asset solves at once. First, demand isn't optional. People need food regardless of what the economy is doing. A recession doesn't reduce how many meals get eaten. It might change what's on the plate, but the underlying demand for farmland's output never disappears. Second, farmland has historically held its value during inflationary periods better than cash or bonds, because the price of what it produces tends to rise along with everything else. When a dollar buys less, land that grows food becomes relatively more valuable, not less. Third, and this is the part almost nobody talks about, water rights. In large parts of the American West and Midwest, owning farmland means owning access to water in a world where fresh water is becoming a genuinely scarce resource. That's not a hypothetical risk. It's already reshaping land values in states like California and Arizona. None of this means one person controls the food supply. American farmland ownership remains deeply fragmented. Millions of acres, millions of owners, and institutional investors still represent a small fraction of the total, but the direction of the trend matters. Long-term capital is moving toward an asset that produces something the world will always need, at a moment when that asset is getting harder to find. And if farmland is about controlling what people need to eat, the next category is about controlling where they live. Drive through a newer American suburb, and there's a decent chance you're looking at a house that isn't owned by a family, it's owned by a fund. Over the past 15 years, institutional investors, companies that pool money from pension funds, insurance firms, and wealthy individuals have become significant buyers of single-family homes, converting them into long-term rental properties. This wasn't always the model. Before the 2008 housing crash, buying up individual homes at scale barely existed as a strategy. Afterward, with prices depressed and rental demand rising, it became one. The logic, from an investor's perspective, is straightforward. Single-family rentals produce steady cash flow. Demand for rental housing has grown as home ownership has become harder to reach for younger buyers, particularly in high-cost metro areas. And unlike an apartment building, a portfolio of single-family homes can be built gradually, house by house, without needing to win a single massive deal. Here's where the honest version of this story gets more complicated, and it deserves to be treated carefully. There's a real, ongoing debate, discussed in Federal Reserve research and covered extensively by outlets like the Wall Street Journal and Bloomberg, about whether institutional buying meaningfully worsens housing affordability, or whether it's a smaller factor compared to zoning restrictions, construction costs, and years of underbuilding relative to population growth. The honest answer is that the evidence is mixed, and reasonable economists disagree. Institutional investors still own a relatively small share of the overall single-family rental market nationally, marginally, though their share is meaningfully higher in specific fast-growing metro areas. What's not up for debate is the trend line. The share has been rising, not falling, for over a decade. Housing solves a similar puzzle to farmland. It's an asset tied to a need that never goes away, and a supply that can't expand quickly. But there's a third category taking that same logic and applying it to something almost nobody was thinking about 5 years ago. Every time a new AI model gets announced, the story usually focuses on the software, the model, the benchmark scores, the demo. Almost nobody talks about what that model actually runs on. Here's the chain nobody sees. AI needs data centers. Data centers need enormous amounts of electricity. Some large facilities now consume as much power as a mid-sized city. That electricity needs to come from somewhere reliable, which means land near power infrastructure suddenly becomes valuable in a way it never was before. Those data centers also need water for cooling systems, and high-capacity fiber networks to move data at the speeds AI requires. Land, electricity, water, fiber. None of it is software. All of it is physical. This is where the largest technology companies in the world, Microsoft, Amazon, Google, and the ecosystem of chipmakers like Nvidia supplying them, have become some of the most aggressive infrastructure buyers on the planet. According to company filings and reporting from Reuters and Bloomberg, capital spending on data center construction by major cloud providers has climbed into the tens of billions of dollars annually, with land and energy contracts signed years ahead of when the facilities will even open. This is the part of the AI boom that doesn't trend on social media, because it's not exciting to look at. Nobody's posting pictures of a substation upgrade, but it might be the most consequential infrastructure build-out in a generation, because it's happening at a scale and speed most people haven't registered yet. And once you understand that AI runs on physical infrastructure, one more industry starts to make sense, the one that moves everything else around. Here's a question that sounds simple until you actually think about it. What does it take to get a product from a factory in Vietnam onto your doorstep in 3 days? Ports, rail networks, trucking routes, and warehouses. Thousands of them, strategically placed close enough to population centers that next-day delivery is even physically possible. Amazon didn't become one of the most valuable companies on Earth by selling products. It became one of the most valuable companies on Earth by controlling the infrastructure that moves products. A network of fulfillment centers so extensive that competitors spent a decade trying to catch up and mostly couldn't. That's the real lesson buried in the logistics category. The company that controls the pipeline usually captures more value than the company that just sells what flows through it. Ports controlling shipping access, rail lines controlling freight movement, warehouses controlling the final mile. Whoever owns those choke points has leverage that a retailer selling a single product category will never have, no matter how good that product is. This is why warehouse real estate, unglamorous, invisible, easy to ignore, has quietly become one of the most sought-after asset classes for large investors over the past decade, according to commercial real estate data cited by the Wall Street Journal. It's the physical backbone of an economy that increasingly expects everything to arrive fast, and somebody has to own the buildings that make that possible. Land, homes, data centers, logistics. 4 categories, 4 different sectors, and one strategy running underneath all of them. Here's the payoff. The thing that connects everything you've just heard. Farmland, rental housing, data center infrastructure, warehouse networks. These aren't trendy bets. They're not the kind of investment that doubles in 6 months or gets talked about at dinner parties. What they share is something much less exciting and much more powerful. Cash flow, scarcity, long-term demand, and infrastructure that compounds in value precisely because it can't be replaced quickly. That's the actual pattern behind billionaire investing that most retail investors miss entirely. It's not about finding the next hot stock or timing a trend before everyone else catches on. It's about identifying the assets society will need regardless of what happens in the news cycle, and buying them before the rest of the market fully prices and how essential they'll become. Farmland doesn't need a headline to keep producing food. A data center doesn't need a viral moment to keep powering AI models that companies are now dependent on. A warehouse doesn't need to trend to keep moving packages through a supply chain that never stops. This is what separates infrastructure investing from speculation. Speculation bets on attention. Infrastructure bets on necessity. So what does any of this actually mean if you're not managing a multi-billion-dollar portfolio? Realistically, you're not going to buy 10,000 acres of Nebraska farmland or fund a data center. That's not the takeaway here, and pretending otherwise would be dishonest. But the principles underneath the strategy scale down just fine. Invest in assets that produce something people genuinely need, not just something that's trending this month. Think in decades, not quarters. Most of the wealth created by these categories didn't come from a single lucky trade. It came from being patient while an asset nobody else wanted quietly became essential. Pay attention to infrastructure, even the boring kind, because the businesses and assets that everything else depends on tend to hold value longer than than the businesses that just sit on top of them and follow economic incentives instead of headlines. The people moving the most capital rarely explain themselves in a press release, but their purchases tell you exactly what they believe is coming. History shows that wealth often follows the assets society can't function without. The question was never really whether billionaires are buying them. It's why they believe those assets will matter even more in the decades ahead.